Ashwini Agarwal joins us now, founder with Demeter Advisors. Let's take our conversation forward. Ashwini, good morning. Thank you for joining us.
Morning, Nikunj.
I asked this question, or perhaps I'm asking this question to just about everybody. In India, the bulls are the boss. For Wall Street, the bears are the boss. Who's the real boss?
Very interesting question, Nikunj. 2008 taught us that when there are wildfires, some of the tallest trees also, get hurt. And my sense is that the rest of the world is going through an extremely traumatic time, given what's happening to liquidity in these markets, given what's happening to rates, and how rapidly these economies need to slow down to correct some of the imbalances that are there. You're right. At this point, the Indian market seems to be ignoring all the gloom and doom that pervades globally. But this is very unnatural. It's very, very unnatural for one market to quote unquote decouple from the global sentiment. So what you probably saw in September and in August was some correction of the massive amount of foreign selling that had happened in the preceding 7 or 8 months. But going forward, if the global environment remains as poor as it is right now, I would expect foreign inflows to slow down a little bit. Now, the interesting point is that the domestic investor in India is full of vim and vigor. They've made money over the last 2.5 years. They've stayed put, and they managed to absorb a record outflow of 2.5 lakh crores of foreign selling over the latter part of 2021 and first half of 22. So to that extent, they may remain in the game and they may sort of hold back some of the downside that you're seeing in the Indian market. But I would be a little cautious to paint a rosy picture and say that, we are off to the races. We don't care what's going on in the world.
When will realization haunt us? This year looks like there is no point in getting into this global macro versus India micro debate. So do you think we are close to that moment of reckoning?
Yes, you are, because at the end of the day, India, in hindsight, correctly, not spend as much as the West did on addressing COVID-related slowdown. We also are reaping the benefit of structural changes that took place between, say, 2017 through till 2020, which included cleaning up of the bank balance sheets. It included GST and probably RERA to some degree. And all of these are now starting to pay back. So obviously, yes, this macro debate is very much in India's favor. And I also point to, what you alluded to, that micro versus macro debate. I think the narrative in India is going to be very bottom up, very stock specific, because I think the business cycle is on an uptake. And when the business cycle is on an uptake, there are a lot of bottom-up investing opportunities that may become available if one were to sift through the 5,000 odd companies that are listed in India. I'm sure we can all find 20, 30 ideas that work for each one of us.
Sure, we can. Before that, though, Ashwini, just wanted to highlight what your anticipation and expectation is from the Fed. Because like you rightly said, we may feel we're decoupled, but the world is pretty much one, right? And given the fact that there are so many central banks which were slated for their policy decision this week itself, I mean, the Swiss bank yesterday has shocked everyone with 100 bips hike. So wanted to understand, because 75 bips is something that one is already anticipating and the markets may have digested that, but a part of the market is also working with 100 bips hike from the Fed. What happens in that case? Does it then sort of derail this India momentum and rally?
So my personal view, again, I'm not an expert on US rates. My personal view is that the market is already fearing 100 basis. So if it turns out to be 75 basis, you'll probably see a small relief rally. But the question is not, what happens tonight. The question is what happens over the next 3 to 6 months to 12 months. I mean, we need to see a change in narrative where the world becomes more comfortable with inflation. We are not there yet. And for a sustainable rally to emerge, for a sustainable risk asset rally to emerge, we need a change in narrative, which moves away from inflation control to supporting growth. Now, at least what appears to be the case is that after almost like 15 years of one-way monetary easing, barring small episodes, the central bankers globally seem to be joined at the hip, saying that we need to lick inflation. Now, this to me is not something that's going to get addressed by just this rate hike. I think it needs a lot of slowdown globally, and that might take some time to pan out. So I think to answer your question in a short message again, 75 basis points, you see a relief rally, and then it rolls over again. 100 basis points, you probably have priced it in and the market goes nowhere. And then, we wait for the minutes to see what each one of the members of the MPC have said and so on.
Okay. So looking at the market positioning in terms of risk versus reward, opportunity versus risk, what should one do?
My personal view is one should not commit new money to the market at these levels. I think, if you are simply asking that should investors put in new money to work, I would say don't do it. I would say just wait because I would want to wait for the global dust to settle down. The way I think about this is slightly differently. I mean, we had an all-time high on the Nifty of about 18,600. So what happens? Worst case, you get a 10% upside. But your downside on the Nifty could be as much as 20% if the world really goes through a terrifying, fourth calendar quarter of this year. And, that's the risk reward on the Nifty. On individual stocks, it could be very different. There could be areas where you could still make money. As I said, that, India is going through an economic expansion, and barring some pockets which are export oriented, you may continue to see very supportive earnings coming through. There is not much leverage in the system and so on. But I think from a market perspective, the risk of losing more money than making some is what appears to be the case right now to me.
I wanted to also understand your outlook on the entire manufacturing space, because a lot of people that we speak to say that India is on the cusp of a manufacturing renaissance, given the fact that we are seeing investors as well move out of China. We're seeing energy prices in Europe as well through the roof. It seems like when it comes to a preferred destination for manufacturing, India stands out. So how would you like to play that theme?
So you're absolutely right. I mean, this is one of the things that has, it is serendipitous almost, the way so many factors have come together and they're supporting the Indian industry. So obviously, this is a place to be investing into. You could buy machinery players, you could buy engineering companies that are involved in setting up new plant and machinery. You could buy people who are making electronic products, consumer products to be sold in India with the help of PLI, bringing in technology from overseas or tying up with overseas technology suppliers or contract manufacturing. There are many ways to skin this cat, and a lot of it is getting priced in, including defense, for example. But yeah, there could be opportunities out there. So bottom up, very story specific. But I would also like to caution that when we speak about China Plus One, or we speak about the energy crisis in Europe, it's going to have different impact on different companies. I mean, there could be manufacturing companies out there who have a raw material linkage or who have a supply chain going back into Europe, and you could have as China slows down a little more, you could have Chinese companies competing more aggressively in the international market. Global demand is slowing down in any case. So I would say that outward looking demand is not something that I would bet on. And I would want to ensure that insofar as possible, the raw material linkages or energy dependence for the specific company that you wish to invest in is secure. So those are the kind of two pointers I would highlight.
Ashwini, the last time we were talking about, you said you're underweight IT, but you could be constructive on IT if they fall a little bit more. Have they fallen enough for you to take a relook? And I ask this because soon we're going to be hearing from the managements and we're going to be getting into the quarterly numbers.
Yeah, so very, very interesting. You know, I've been wrestling with this question for the last week or so. It does start to look very interesting here, I have to say. I mean, from here, the upside to downside ratio is inverse as compared to what it is for Nifty in my personal view. You know, I have usually held the view that, you know, if your customer is in a problem and you're in a services business, you will face a problem, and that is true for IT services as much as it is for any other business. But I also think that these are best-in-class companies, generate a whole bunch of free cash. Valuations which are very expensive towards the end of 22 are now starting to look reasonable. So, you know, if you were to look a year out from here, you could probably, on some of the big names, you know, have a downside of 10%, upside of 20%. So it's quite the inverse of what my view on Nifty is from a risk-reward perspective.
Banks, I mean, one would argue, Ashwini, that banks have the cleanest outlook we've seen in a long time.
Yes.
Credit book, NPA, fresh cycle, NIMS. So while IT is getting into that value zone, can I say banks still have a long way to go?
Absolutely. You're absolutely right. I think at least at the moment, there doesn't seem to be any indication of why or how this party should stop in the near term. And I would be partial to the smaller banks because as we saw in IT, if you observe over 2020 and 2021, you made the maximum return on the small IT names, IT services names. You made money on the big ones, but you made more money on the smaller ones. And it is a typical behavior, you know, when a cycle is in your favor, the beaten down names, the cheaper names, the smaller names tend to give you a disproportionate upside from a stock price perspective. So that is very much still in play, notwithstanding the kind of rally we have seen in several small banking stocks.
So if one is looking at next 6 months, you would say don't invest. But if one is looking at beyond a year, would you say that a 15-20% return would be is a fair possibility?
It's a fair possibility, Nikunj, but the way I think about it is that, you know, markets are not cheap in aggregate. Okay, so one has to be very, very stock and very, very opportunity specific. If you were to buy the Nifty, for example, at 7,600, because let's just talk about the markets, you could be in a situation where you really don't make any money 1 year out. You know, I entered the market in 1992, and between 1994 October through till pretty much middle of 2003, the Sensex went nowhere. So you would see, you know, rallies of 10% and falls of 10 to 15%, and the Sensex for those nearly 9 years traded in a broad range of 3,200 to 3,900. There were episodic lows of 2,800 and there were episodic highs of 4,500 and 6,000 in January 2000. But by and large, it remains in that range. And that happened because the world was not in a great shape in the mid-90s, just as it is today. And you had a huge amount of restructuring going on in India as a result of the reforms that were undertaken in 1991. I think we are in a similar situation at this point. I would say that this is not a 10-year story, but I think over the next 1 or 2 years, it's quite possible that the market doesn't really go anywhere.
Okay, appreciate your time. Thank you so much for spelling out your outlook on the markets as well as individual sectors and fund flows. Just a quick